Chapter 21, International Corporate Finance. Let's see what you will learn in this chapter, or at least the most important key topics. First, we will look at exchange rates. So what does it actually mean, an exchange rate for some country's currency? How are they quoted? There are actually two ways. And what do they really mean? Then we will look at actually two different types of exchange rates used in the real world, in the business world. The spot exchange rate and the forward exchange rate. And we will look at how they're different. Then we will look at purchasing power parity, interest rate parity, learn what those are and how they can be applied to calculate future expected exchange rates, let's say in 1 year, in 2 years, and so on. And then finally, we will link everything that we have learned from all those topics to finding the net present value for a project that takes place overseas. In other words, solving international capital budgeting problems. So a lot of companies these days have operations in more than one country. So not just, offices in the United States only, but offices in other countries in this world. These companies are called international corporations or multinational corporations or simply multinationals. And clearly, when you operate in more than one country, things get kind of complicated. Let's see what the problems may be. Let's say we have an American company and it would like to start some new project. So maybe just open another location, right? It could be as simple as that, in Europe. So the best approach to figure out the profitability of this new investment opportunity is to calculate the net present value, NPV, for it. So the NPV is always calculated the same way. It's equal to the investment in year 0 or a negative cash flow in year 0. And then we add discounted future cash flows. So cash flow in year 1 divided by 1 plus the required return or the discount rate. Then we add cash flow from the second year, discounted back by 2 years. So 1 plus the discount rate is squared, and so on. Okay, what are the problems when the NPV is for an overseas project? Well, first of all, the cash flows from this overseas project are no longer going to be in dollars. They will be in euros, right? If it's a project that would be taking place somewhere in Europe. How would we solve this problem? Well, we need to use the exchange rate to go back from the euro to the US dollar. Okay, problem number 2. Technically, the exchange rate is something that's not, like static. It doesn't remain unchanged over the years. It's something, think of like stock prices. It's also something that's changing all the time. So you cannot do like sort of one fits all approach. You cannot use, look up the exchange rate as of today between the euro and the dollar and apply it to convert your cash flows from year 0 of the project, year 1 in the future, year 2 in the future, and so on, back into dollars. It cannot be the same exchange rate, in other words. So the solution to that is we need to use the exchange rate that's correct for that year in the future. So we may need to use different exchange rates for cash flows in different years of our overseas project. And we're going to learn in this chapter how, the formulas that give us the best estimate for future exchange rates. And the third problem is, so not only do the cash flows from an overseas project present like an additional problem for the company, also the same, a similar additional problem may arise from the discount rate. Which discount rate is appropriate to use to find the NPV of this overseas project? Is it the return required for similar projects domestically or in Europe? The solution to this problem is we may need to somehow incorporate the information on both the European and the American required returns somehow in our net present value calculations. Okay, so our main goal is basically to figure out how those problems would be solved. So our main goal is to learn how to do international capital budgeting problems, like taking into account all those issues and knowing how to solve them. So we will be calculating international net present value for international projects. And for this, we will need to learn how to read exchange rate. We need to learn how we figure out what makes exchange rates change, and be able to figure out future exchange rates over the years of our overseas project. And then we will also need to look at interest rates, which will be kind of part of the discount rate issue. So we will need to use the information on differences in interest rates in domestic and foreign countries. Let's start with a little bit of concepts, some international finance terminology. Cross rate. This is the so-called implicit, rather than the actual, exchange rate between two currencies. Typically, it's not for the United States, but it's for two foreign countries, quoted in some third currency, usually the US dollar. So let's see what it's all about using the following example. Let's say the exchange rate, the current actual exchange rate between the US dollar and the Japanese yen is $1 equals 106 Japanese yen. Also, the actual exchange rate between the US dollar and euro is $1 equals 0.68 of a euro. So we have two exchange rates. Both have $1 and then they have the amount of a foreign currency. How would we find the cross rate between the yen and the euro? Because that's what the cross rate would mean in this example. So we need to write something like 1 yen equals this many euros. Or we may want to write it as 1 euro equals this many yen. So how do we do all that? First, because the way the two exchange rates are given allows us to say that 106 Japanese yen equal 0.68 of a euro, we can, basically, so because both amounts equal $1, we can set the euro amount and the yen amount equal to each other. So we write 106 Japanese yen equals 0.68 of a euro. And then we want to calculate the cross rate between the yen and the euro. So we can divide both sides of 106 equals 0.68 by 106. What do we get? 106 yen divided by 106 gives us 1 yen. And 0.68 of a euro divided by 106 gives 0.0064 of 1 euro. So this is the exchange rate, the cross rate, the implied exchange rate between the yen and the euro, expressed in terms of how many euros it is per 1 Japanese yen. But of course, there is another way of writing this implied exchange rate or the cross rate between the yen and the euro. And that would be in terms of how many yen it is per 1 euro. For that, we again go back to the little formula that a little like equation that we had, 106 yen equals 0.68 of a euro, and instead divide both sides of it by 0.68. Because what we want is, we want to have 1 euro this time. So to kill 0.68 and have only 1, we need to divide by 0.68. And we divide both sides of this little formula, 106 and 0.68, by 0.68. So when we divide 106 by 0.68 on the left side, we get 155 yen. And 0.68 of a euro divided by 0.68 gives us mathematically 1. So this is the second expression of the implied exchange rate, or the so-called cross rate between the Japanese yen and the euro. 155 yen equals 1 euro. So it's the amount of yen per 1 euro. Euro currency. Money deposited in a financial center outside of the country whose currency is involved. First, notice how this definition has no mention of Europe, right? And that's actually an important, detail about this term. Euro currency has nothing to do with Europe. Basically, the part euro means overseas. That's kind of what it means in this context. So what euro currency means, it means, for example, we can say euro dollars. So what's euro dollars? It's dollars, but not in the United States, but outside the United States. So US dollars deposited in banks outside the US banking system. There's also euro yen. That's Japanese yen, but not in Japan, but outside of Japan. So outside of Japan's banking system. There's also euro peso outside Mexico, right? There is euro yuan, Chinese yuan, but outside of China. There's also euro, right? Euro. What is that? Euros outside of Europe, outside of the European banking system. So somewhere else in other parts of the world. Then similarly confusing are the next two terms, euro bonds and foreign bonds. So again, in the term euro bonds, the part euro has nothing to do with Europe. It again means the same thing as in euro currency, being outside of the country. So euro bonds and foreign bonds are both bonds. Remember what a bond is? A bond is a financial security that you can buy or sell. Who sells bonds? Like originally? Originally, it's companies or governments that sell bonds with the purpose of borrowed money. So the amount of money that each bond sells for is how much has been borrowed with that one bond. Anyway, so euro bonds and foreign bonds are both bonds sold in other countries, overseas. Now let's see what the difference is. Euro bonds, by definition, are international bonds issued in multiple countries, but denominated in a single currency, which is usually the issuer's currency. Let's look at an example that will make it clear. Euro-yen bond. It's a bond sold by Japan. So maybe Japanese companies want to borrow money, or the Japanese government wants to borrow money by selling bonds. But these bonds sold by Japan are sold outside of Japan, and their price is quoted in yen, which is the currency of the issuing country. So there is a euro-yen bond, there is a euro-dollar bond. So what would be a euro-dollar bond? Bonds sold by American companies or governments, issued by American companies or governments, but actually sold outside the United States. Euro bonds, so European companies or governments bonds sold outside Europe and price quoted in euros, and so on. Foreign bonds are actually very similar to euro bonds. Foreign bonds are also defined as international bonds issued by a foreign entity. So entity means, again, either some company or a government in a single country rather than multiple countries, denominated in that country's currency. So let's look at some examples. Yankee bonds. It's bonds issued by foreign banks and or firms, but sold in the United States, and the price is in the US dollars. So unlike euro bonds, foreign bonds are quoted in the currency of the country in which they are sold, rather than, like with euro bonds, they're quoted in the currency of the country where they're coming from. Then there are other names which are actually all pretty funny. Samurai bonds. That's bonds sold in Japan. The price is in Japanese yen, but who issues the samurai bonds? Other countries, companies or governments. Bulldog bonds. That is kind of linked to the Great Britain. So sold in Great Britain, issued by other countries. Kangaroo bonds. That's Australia, and so on. Then we have one more term. It's actually an abbreviation, Libor, Libor, which stands for London Interbank Offer Rate. This is defined as the rate most international banks charge one another for overnight euro-dollar loans. So in other words, kind of to simplify this definition, banks around the world can borrow money from each other overnight, just for one day loans. What interest rate do they charge each other in this international platform? The Libor rate. The Libor rate is also something that is changing regularly. It's published daily by the British Bankers Association, which represents banks of over 60 countries. Where do we see the Libor rate in this country? Actually, it's used is a very important interest rate benchmark for home loans. So if you want to buy a house, you need to borrow money from a local bank. You walk into the bank and the bank might tell you, okay, today's annual interest rate on home loans is Libor rate plus, let's say, another 1.5%. But the Libor rate is used as a benchmark for home loans only when the home loans are so-called adjustable rate mortgage loans, where the rate is changing every year rather than fixed rate loans. With adjustable rate loans, the rates are fixed for some initial period, so let's say 3 to 5 years, and then it starts changing once a year, together with the Libor rate, kind of following the Libor rate. Okay, what are foreign exchange markets? It's the market in which one country's currency is traded for another country's currency. You should not be trying to imagine like some physical location, like a single physical location, kind of like, for example, New York Stock Exchange, in which the currencies of different countries are exchanged for one another. It's more like a very general term, kind of summarizing all the different, platforms where the currencies can be exchanged. It's more like what is known as the over-the-counter OTC market. There is no single location where traders get together. The market participants, who are the market participants? Who are the traders of currencies? They are commercial and investment banks around the world. They are importers, exporters, so different companies that focus on importing and exporting stuff. People who buy foreign stocks and bonds, speculators who try to profit from changes in exchange rates. It's also, travelers, people who travel overseas, who go to a bank to exchange one currency to another. So all these are different participants. And like all these different participants, they communicate on the internet, so the currencies can be exchanged on the internet or on the phone, kind of in many different ways. And that's what the over-the-counter market means. The opposite of the term over-the-counter market would be something like a single physical location where the trade occurs. In this world, the most sort of important currencies that are traded the most are the US dollar, the Japanese yen, the European euro, and the British pound. And this entire foreign exchange market is the world's largest financial market. This refers to the, let's say, the value in money, let's say in dollars, of how much is being traded every day. And that's much larger than the value of all shares of stock, for example, or bonds traded every day. So it's the world's largest financial market. Now let's start looking at some numbers. So let's kind of take a step back and think about what we actually mean by an exchange rate. An exchange rate, let's say between the yen and the dollar, or the dollar and the euro, is really nothing but the price. It's the price of one country's currency in terms of another. So for example, you can think about traveling from the United States to Japan. If you exchange dollars into Japanese yen, you're basically buying Japanese yen. You're paying dollars for each yen that you want to have. So it's really the price. As an example, let's say we are looking at the exchange rate between the US dollar and the Chinese yuan, CNY. The exchange rate for Chinese yuan is the amount of Chinese yuan per $1, because it's really the price. And let's say that's 6.83 Chinese yuan per $1. So for example, if American tourists travel to China, they bring dollars to the local banks, and the local banks, for every dollar, will give them 6.83 Chinese yuan. So it takes, and also the other way around, let's say Chinese people come to visit the United States, they would be paying 6.83 Chinese yuan to buy each US dollar. So it kind of goes both directions. Instead, we can write the exchange rate, the same exact exchange rate between the Chinese yuan and the US dollar differently. We can instead write 1 Chinese yuan equals 0.15 of a US dollar. How do you think I went from $1 equals 6.83 Chinese yuan to 1 Chinese yuan equals 0.15 of a dollar? Well, we had an example similar to this a few slides earlier, the one where I explained the cross rate. So if you look at this first expression with which we started, right? $1 equals 6.83 of a Chinese yuan. If you want to have 1 Chinese yuan, then we would need to divide 6.83 by 6.83. So it gives us 1. If we do that for both sides of this little equation, right? So if you also divide $1 on the left-hand side by 6.83, then we get 0.15 of a dollar, or 15 US cents. So you can notice that the two numbers, for example, 6.83 and 0.15, they're related kind of in a reciprocal way to one another. For example, we can also go back from the second expression, 1 Chinese yuan equals 0.15 of a dollar, to the first expression, $1 equals 6.83 Chinese yuan. by dividing both sides, the left-hand side and the right-hand side in the first expression, or the second one, by the number that we want to be 1 instead. So if we want to see $1 instead of 0.15 of a dollar, we need to divide both 1 Chinese yuan and 0.15 of a dollar by 0.15. And this is how we would get $1 on the right hand side, and on the left hand side, when we take 1 and divide it by 0.15, we get 6.83 Chinese yuan. Okay, let's do an example, another example. You are traveling to Germany. You arrived to your hotel, you went downstairs to the lobby and decided to exchange $50 into euros. The person in the lobby gives you back 34.02 euros. Question: what was the exchange rate that was used for this transaction? And it needs to be expressed in terms of euros per $1 as well as in terms of dollars per €1. So we want to do two calculations that will mean the same thing. Solution. So first, we know that $50 is equivalent to 34.02 of a euro, right? So we can just set the two numbers equal to each other. $50 equals 34.02 of a euro. Then, if you want to write the exchange rate in terms of how many euros it is per $1, then where we have $50, we want it to be now $1. So we want to divide 50 by 50. And we will do that for both sides of this equation. So we divide both sides by 50. And we get $50 divided by 50 on the left-hand side. And on the right-hand side, we have 34.02 of a euro divided by 50. When you simplify it, you get $1 on the left-hand side equals 0.68 of a euro on the right-hand side. This is the exchange rate between the dollar and the euro expressed in terms of euros per $1. But there's always another way, right? And that's the second part of our question. Let's express the exchange rate in terms of dollars per €1. So we want to go back to, these, equivalents between $50 and 34.02 euros, right? This time we are saying we want to see €1. So where we want to have 1, the number that we have there currently is what we need to divide both sides of this equation by. So to get €1 instead of 34.02 euros, we need to divide 34.02 euros by 34.02. And we also do that division for the left-hand side, which is $50. So $50 divided by 34.02 equals 34.02 euros divided also by 34.02. When this is simplified, on the left-hand side, where we have dollars, we get 1.47 of a dollar, $1.47. And on the right-hand side, we have the €1 that was our goal. So we have just answered the question. We found the implied exchange rate between the dollar and the euro two different ways. First, $1 equals 0.68 of a euro, and second, €1 equals 1.47 of a dollar. Notice that to find that second exchange rate expression, €1 equals 1.47 of a dollar, we could do it a bit differently. We could start with the first exchange rate expression, $1 equals 0.68 euros, and divide both the left-hand side of it and the right-hand side of it by 0.68. And that would give us the same answer. When $1 is divided by 0.68 on the left hand side, we get $1.47. And then when the right hand side, 0.68 of a euro, is also divided by 0.68, we get €1 remaining. Let's see how exchange rates are quoted in the finance world. You see, a part of a table in the Wall Street Journal from Monday, June 16th, 2008. So it's a little bit old. We have different countries' currencies, and different countries are also grouped by the world region. Americas, which have Argentina, Canada, Mexico, and so on. We have Asia Pacific, which includes Australia, Hong Kong, India, Japan. We have Europe, which has the Czech Republic, the Euro area, Russia, Turkey, and so on. And we also have the Middle East and Africa, which has Egypt, Israel, and other countries. So this table has 3 columns. Don't worry about the third column, which has changes in bold. Let's focus on the first and the second columns. The first column in this table is labeled as in US dollars. So what do you think this means? This is also called the US dollar equivalent. And it's the exchange rate quoted in terms of how many dollars it is per one unit of foreign currency, also known as direct quote or American quote. Let's look at an example. The first line, Argentina peso 0.3290. What does it mean? It means it takes 32.9 US cents to exchange into 1 Argentinian peso, right? So it's how many dollars, US dollars, it is per 1 Argentinian peso. Now the second column in this table, it's the other way that the same exchange rate can be expressed. It's labeled as per US dollar, which means for every number in this column, we always have $1, right? And the numbers in this column are the amounts of other countries' currencies. So this has, again, a few different names. Currency per US dollar, which is the exchange rate quoted in terms of the amount of foreign currency per 1 US dollar. It's also known as the indirect quote or the European quote. Again, the term European quote has nothing to do with Europe. Kind of confusing, right? What does the number for the Argentinian peso mean? The number is 3.0395. It means $1 equals 3.0395 Argentinian pesos. So the 2 columns for each country shows, the 2 different ways that the exchange rate between the US dollar and that country's currency can be expressed. Okay, now that we know how to read exchange rate quotes, let's see if you can figure out the solutions to the next couple of problems. Let's say you have $10,000. Let's say you go to Japan, right, to travel. Based on the exchange rates in the same exact table, how many Japanese yen can you buy with $10,000? Okay, so from this table, we are looking up the row for the Japanese yen. 2 columns. Column 1, labeled as in US dollars, says 0.009241. Column 2, labeled as per US dollar, says 108.21. Okay, so to figure out the So we can use either exchange rate, either one, either from the first column in this table or from the second column, as long as you use it correctly. Let's say we are using 108.21 from the second column. Again, what does this number mean? It's yen per $1. 108.21 Japanese yen per $1. How can we then figure out, using this exchange rate from the second column, how many Japanese yen 10,000 US dollars can buy us? We multiply $10,000 by how many yen each dollar can buy us. So 10,000 multiplied by 108.21 gives us 1,082,100 Japanese yen. So yeah, in Japan, everybody is millionaires. How would you instead solve this problem using the exchange rate from the first column, which is 0.009241? So this is labeled as in US dollars, right? So how many dollars gives you 1 yen? And the way you would use this number is, because you have $10,000 and you know how many dollars gives you 1 yen, you would need to divide $10,000 by 0.009241 from the first column. And the answer you would get will be identical to the first solution, the answer to the first solution, 1,082,100 Japanese yen. So you would either multiply by the number from the second column or divide by the number from the first column. Example number 2. Let's say you're visiting Mumbai in India and you want to buy a souvenir that costs 1,000 Indian rupees. How much does it cost in US dollars? So let's say you're trying kind of to do the math in your head. Okay, is it expensive or not? You're probably going to try to convert it into dollars, right? So how much is it in terms of the US dollars? Well, let's look at this table again and find Indian rupee. That's again 2 numbers. From column 1, it says 0.02332. Column 2, the number is 42.882. How do we use either one of these 2 numbers? Well, let's say we want to use the number from the second column, just like we did in the previous example. That's 42.882. This is how many rupees it is per 1 US dollar. So 42, almost 43 rupees gives you $1. Okay, how do you find the implied price in US dollars? Do we take 1,000 rupees and multiply by 42.82 like we did in the previous problem? Actually, no. Now we want to go back from the foreign currency amount to the US dollars, and everything becomes sort of reversed. Now we want to divide rupees by rupees so that rupees cancel out as the unit of measurement, and we are left with dollars. So we take 1,000 rupees and divide it by 42.82 rupees per dollar, which gives us the answer in dollars, $23.32. So you might decide, oh, okay, that's pretty expensive. No, I'm not going to buy this gift. Again, the same second question. How would you instead use the other expression of this exchange rate between the rupee and the dollar from the first column? The first column shows 0.02332. What does it mean? It's labeled as in US dollars. So this is how many dollars give you 1 rupee. if you want to use instead this number to calculate the price for the souvenir in dollars, you would need to multiply. So you take rupees, multiply by dollars per rupee, and then rupees basically kind of cancel out because you're multiplying by the number that has rupees on the bottom because it's per rupee, per 1 rupee. Rupees cancel out and the unit of measurement that's left is the dollar. And you would get the same answer, $23.32. There are a whole bunch of different websites where you can kind of see, how many rupees are equivalent to how many, let's say, euros or how many dollars. So kind of you converting any amount of pretty much any country's currency into the currency of any other country that you like. So for example, this website www.x-rates.com/calculator. So it allows you to convert currencies. It's the currency calculator page. Spot trade versus forward trade. So on top of there being two different ways to express the exchange rate, like today's exchange rate between any two countries' currencies, there are also two different types of exchange rates. Not just how it's expressed, but different ways they can be used. So let's call that, so basically we can exchange currencies one into another using the exchange rate in as part of two different types of trades. So there are two types of currency exchange transactions out there: the so-called spot trade and the forward trade. Spot trade is exactly what we have been talking about until now. So everything happens on the spot. That's where the name comes from. Immediately. So you walk into a bank, the bank immediately gives you some amount of euros in exchange for your dollars, right? So let's say today or year 0 on our imaginary timeline is when the exchange of one currency for another takes place. What is then the forward trade? The forward trade has two important points of time. So there are two things that happen in this forward trade process. We can again think of today or year 0 on a timeline and another point of time sometime in the future. So what happens today and what happens at that point of time in the future? What happens today is just locking in a specific exchange rate. It's not going to be used today. There is no transaction that would be taking place right now. The transaction will actually take place at that future time t. And the exchange rate that will be used at time t in the future is the one that was agreed upon today in year 0. So today we agree on the exchange rate. At that specific point of time in the future, we actually use it and exchange the currencies. So today we just agree to exchange one currency for another at a certain time in the future at a specific exchange rate. And at time t in the future, so it could be, let's say, in 6 months, right? What happens is the actual exchange of one currency for another using that exchange rate that was agreed upon in year 0. Going back to the spot trade, the exchange rate that's used in the spot trade is called the spot exchange rate. We denote it as capital S subscript 0. S stands for spot, 0 stands for year 0. So the exchange rate that's used today. How is it expressed? Is it how many dollars per, for example, yen, or how many yen per dollar? It's actually $1 equals this amount of, let's say, Japanese yen. Then the exchange rate that's locked in year 0 to be used at time t in the future as part of the forward trade is called the forward exchange rate. The notation is capital F, subscript lowercase t. So it's the exchange rate that's agreed upon today that will be used at time t in the future. A little detail about the spot trade. It's an agreement to trade currencies based on the exchange rate today, actually for settlement within 2 business days. So they kind of allow you to wait a couple of business days before you exchange your currency. So it's not really, it does not need to happen right away today. There could be a 2-day delay. But within 2 days, you will be using the exchange rate, kind of going back to, the first business day. So currencies are exchanged on the spot. I already mentioned that this is where the name spot trade is coming from. And that's the exchange rate we've been using so far in all our examples. So let's focus on the forward trade, which is something new. It's an agreement to exchange currency at some time in the future at the exchange rate agreed upon today. If you look again at that table with quotes for different countries' currencies, for the world's important currencies, such as, for example, for the Japanese yen, you will see a few additional rows. So for Japanese yen, there is a 1 month forward, a 3 months forward, and a 6 months forward. So for example, for the 1 month forward rate, in the second column, it says 108.03. So it means 108.03 yen equals $1. What does it mean? It means that you can enter this forward trade agreement today, that will allow you to exchange yen into dollars or dollars into yen, whichever one you are planning to do, using this 1 month forward rate that you're locking in today. So you're locking it in today, you enter this 1 month forward trade agreement, and you will be using this exchange rate in 1 month. Whether you benefit from it or you lose from it, which depends on what the actual exchange rate will be in 1 month, that's a different question. Then the 3 month forward rate is 107.62 yen per dollar. 6 months forward rate is 106.96 yen per $1. Looking again at these exchange rates, as well as the spot exchange rate, which is 108.21 yen per $1. What can we say about the yen and the dollar? In particular, let's answer the following question. Is yen expected to get stronger or weaker over time, like over the next 6 months, against the dollar? And what about the dollar? Is it expected to get stronger or weaker against the yen over the next 6 months? The answer is, so look at the numbers. Spot, 1 month, 3 months, 6 months. We have fewer and fewer yen per dollar. So the dollar is expected to be able to buy you fewer and fewer yen. Is it good for people who hold dollars? No, it's bad. So the dollar is expected to get, we say, weaker over time. Or we can also say the dollar is expected to depreciate against the yen, lose value, right? And the yen is expected to instead get stronger or appreciate against the dollar. And again, you can see that about the yen from the numbers. So let's say, think about Japanese people who will be traveling to the US. Over the next number of months, they would be bringing fewer yen to their local bank to get each dollar. So that's good for the Japanese people, right? So the yen will get stronger or appreciate against the dollar. And that's because the forward rate expressed as yen per dollar is falling. The number is going down for a more distant future. Another term that means the same thing is premium versus discount. So you can also say that since yen is more expensive in the future than it is today, the yen is said to be selling at a premium relative to the dollar. And similarly, the dollar is said to be selling at a discount relative to yen. Okay, let's look at, now that we've covered sort of the basics of exchange rates, what they really mean, how they can be expressed, and two types of exchange rate, spot and forward. Now let's look at how the exchange rate can be used in other sort of international finance contexts. What do exchange rates imply about prices in two different countries? First, the price for the same commodity should be the same in the two countries. This is the sort of the definition of the so-called absolute purchasing power parity, or absolute PPP. We will look at this first. Then forward exchange rates are closely related to expected change in prices in the two countries. This is how the relative purchasing power parity, or relative PPP, is defined. Let's start with the absolute purchasing power parity, and then we will look at the relative purchasing power parity. What the two have in common, and there will be a formula for each, is that they connect the exchange rate with prices in different countries, in two different countries. Absolute purchasing power parity. The idea is that the same commodity costs the same in different countries. So let's say a cup of Starbucks coffee, right? Same size, same like coffee beans, same everything. It should, it makes sense for it to cost the same amount of money in the United States as well as in any foreign country, right? If you just, use the exchange rate. For example, a hamburger costs $2 in the USA. The exchange rate between the dollar and the Japanese yen is $1 equals 120 Japanese yen. How much should the same hamburger cost in Japan if the absolute purchasing power parity holds? In other words, if it's true that this hamburger costs the same amount of money in both countries. So the solution is, if $1 gives us 120 yen, then $2, which is the cost of this burger, should give us the price for the same burger in Japan. So $2 times 120 yen per $1 equals 240 Japanese yen. So 240 Japanese yen is how much the same exact burger should cost in Japan. So it's a pretty simple topic, right? Now, let's think about what this kind of simple looking topic is really all about. What if this burger does not cost 240 yen in Japan, but what if it costs, let's say, 300 yen? What does it mean? So it's cheaper in the US than it is in Japan. Whenever the price does not follow the absolute purchasing power parity, so when it's not what it should be based on the calculation like this, we say that there is an opportunity for you to make profit, or a so-called arbitrage opportunity, riskless profit, in other words. So how would you make profit in this case? Well, making profit means buy something cheap and selling it for more money. So you make profit on the price difference, right? Well, how can you make profit with the kind of the price differential for this burger in this problem? I always tell my students that, well, you start by taking two large suitcases, and then they start laughing because they know what's coming next. And yes, they're right. What I'm going to say next is you go to a local McDonald's in the United States, buy a whole bunch of burgers for $2 each, pack your two large suitcases with those burgers, then you fly to Japan and sell each burger for more money. So each burger, when sold in Japan, will give you some profit, and then your two suitcases full of burgers will give you a huge profit, right? Well, even though this is exactly how you would take advantage of this profit or arbitrage opportunity, kind of guaranteed profit, nobody would do anything stupid like this, right? First, because at the border in Japan, they will tell you, what's all that? They will want you to, give them all the burgers and they will trash them. It's all a perishable product, right? It can go bad. Second, there are typically import like restrictions or limitations on how much of different stuff you can bring into the country. And on top of that, well, you have to pay for your flight to Japan, and that already kills your, at least partially, your potential profit, right? So there are all these different kind of restrictions in real life that don't allow for this kind of profit opportunities to be realized. Have you heard of the Big Mac index? Actually, this is true. This is real. So if you go to this website, economist.com, you will find the explanation about the Big Mac index. It's called Burgernomics. It's actually all real. It's not a joke. So if you scroll down, you will see, for example, a table here on the left. It has different country names: Switzerland, Norway, Sweden, United States, and so on. And then in the rightmost column in this table, it says under/overvalued by percent. In other words, people have researched the price for the Big Mac, how much it should cost in different countries in their local currencies, and compared that fair price with how much it actually costs in those countries. And they calculated this percentage, difference in the between the actual price and what the price should be. So what's the best country to go to if you love Big Macs? Well, you'd wanna fly to the country where it's undervalued the most. So if you scroll down, you wanna find the country with the highest negative percentage. What is that country? That country is Russia. Russia is the winner, minus 70%. So in Russian currency, in rubles, you'll be paying 70% less to buy Big Mac than how much technically you should be paying if it's priced fairly. So welcome to my home country. That's the price, that's the country with the cheapest Big Macs. Well, or you can go to Ukraine, which is right next door. Turkey is the third cheapest country to eat delicious Big Macs. What's the worst country to go to if you like Big Macs? That's the country where it's overvalued the most, and that's Switzerland. Actually, this table shows three countries, only three countries, in which Big Macs are overpriced. Switzerland is number one, followed by Norway, 5%, overvalued by 5%, and then Sweden, overvalued by 4%. Okay, so now you know what this whole Big Mac index is all about. Okay, but let's not spend any more time on it. It's not going to be covered on any of your exams. It's just for general knowledge. Let's do another example on the absolute purchasing power parity, or how much something should cost if it's priced right. Let's say we have a commodity, which is a laptop produced by Dell, a Dell laptop. It costs $1,500 in the United States of America. The same exact laptop costs 1,100 euros in France. What should the exchange rate between the dollar and the euro be if the absolute purchasing power parity holds? This means if the laptop costs exactly, what it should, then what's the exchange rate? So the exchange rate is, and remember how we can express it two different ways. If you want to express it in terms of dollars per 1 euro, then where we now have 1,100 euros, we would need to divide it by 1,100. So we are left with 1 euro. And we also divide by 1,100 the amount of dollars, $1,500. So when $1,500 is divided by 1,100, we get $1.36 per 1 euro. If you instead want to express the exchange rate the other way around, how many euros it is per $1, then you divide both $1,500 and 1,100 euros by 1,500, which is how you would be left with $1. So $1,100 divided by 1,500 gives 0.73 of a euro per $1. So the exchange rate that implies that the absolute purchasing power parity holds, or no arbitrage opportunity in other words, is $1.36 per euro, or 0.73 of a euro per 1 US dollar. Let's summarize the absolute purchasing power parity formula that we used in the last few examples. The price in a foreign country, P subscript FC, expressed in terms of the foreign country's currency, such as, let's say, the price for a burger, 240 yen, the example we had, is equal to the exchange rate, or to be precise, the spot exchange rate, S subscript 0, expressed in the amount of foreign currency per $1, such as, for example, 120 yen per $1, multiplied by the price in the United States, P subscript USA. So that's the price in the USA in the local currency, in the US dollars, such as, for example, $2 for is the price for the local Big Mac. So price for a country equals the exchange rate today, the spot exchange rate, multiplied by the price in the United States. And the important thing is the exchange rate is expressed as how many units of foreign country's currency you get with 1 US dollar. If it was the other expression, then in this formula we would have price USA divided by current spot exchange rate. So this absolute purchasing power parity holds if transaction costs are zero. So for example, in my example I gave you earlier with buying Big Macs for cheap in the US, fly to Japan to sell them for more money over there, the transaction costs equal to zero would mean it's free to get on the plane and fly to Japan. But in real life, there is no such free, thing. Then no barriers to trade, such as no taxes, no tariff taxes, no like restrictions on how much stuff you can bring from one country to another. And also no difference in the commodity between locations. For example, this kind of means that the same commodity has the same economic value in both countries. So for example, in like what's valuable in the US might have almost no value or not being used at all in other countries. But like mentioned earlier, even if you so the absolute purchasing power parity rarely holds in practice, which means we rarely see that the price of some commodity in some country is exactly what it should be. So it's actually typically not true. It's not what it should be. But even though we have this kind of profit opportunity, all these restrictions, transaction costs, barriers to trade, difference in the commodity value between different countries, all of these different issues result in you not being able to take advantage of these profit opportunities. Let's look at what the relative purchasing power parity means. Just like the absolute purchasing power parity, the relative purchasing power parity connects exchange rates and prices in two different countries, except it doesn't look at a specific commodity, let's say Big Mac or a Dell laptop or anything like that. It looks more like at the general overall price level in this country and in some other country. The idea is the relative purchasing power parity shows that relative prices in two countries is what determines the change in the exchange rate over time. So we are now kind of looking at how the exchange rates would be changing in the future when we have the information on the price levels in two different countries. Let me explain this topic using the following example. Let's say we have Japan, and the prices for everything you typically buy in Japan, kind of the overall price level, is expected to increase by 10% over the next 1 year. So if you want to travel to Japan in 1 year, and if you want to be able to buy the same amount of stuff with your dollars that will be exchanged into yen, in other words, to keep your purchasing power unchanged, the dollar should be exchanged into 10% more yen, right? So if everything is 10% more expensive, but each dollar is exchanged into 2% more yen, then you feel like there is no change, no difference to you. So the dollar should rise by 10% against the Japanese yen over the next year. So the expected exchange rate next year, denoted as E and then in square brackets S1, should be equal to S0, the current or the spot exchange rate, expressed as how many yen per $1, as always, multiplied by 1 plus 0.1. So this little formula increases the exchange rate by 10% in 1 year. So 10% more yen per $1. That would leave you, indifferent to the 10% higher price in Japan. Now let's add more information to the story. What else will be happening over the next year? Let's say over the next year, the prices in the United States will also increase, but only by 7%. So we expect a 7% inflation in the US. Then, relative to the US price level in 1 year, prices in Japan will increase by about 3% more, right? And now it changes our conclusion about how the exchange rate should change so that you feel that your purchasing power is unchanged. You can still buy as much stuff with your money you bring to Japan. Now you do not need to hope that the exchange rate will go up by 10%. You would be you'll feel that your purchasing power is unchanged if the exchange rate increases by only 3%. So the expected exchange rate in this case, with the inflation rate of 10% in Japan, and 7% in the US, the exchange rate should only increase by 3%, so that you feel like the higher prices in Japan makes no difference for you. How would we calculate the exchange rate in 1 year? We would take the current or spot exchange rate S0 and multiply it by 1 plus 3%. What is 3%? That's the difference between 10% inflation in Japan and 7% inflation in the United States. Let's apply it to a more specific example. Let's say the current spot exchange rate S0 equals 120 yen per 1 US dollar. Then, with the 10% expected inflation in Japan and the 7% expected inflation in the USA, which implies a 3% higher prices in Japan than in the United States, the next year's expected spot exchange rate should equal 120 Japanese yen, which is today's spot exchange rate, multiplied by 1 plus the 3% difference in the between the foreign and the domestic inflation rates, which gives 123.6 Japanese yen per $1. So if in 1 year the exchange rate increases from today's 120 yen per dollar to 123.6 yen per dollar, you wouldn't care about all these price increases in both countries. Your money, your dollars brought into Japan and exchanged into Japanese yen will allow you to buy the same amount of stuff in 1 year as it can buy you today. In other words, it will keep your purchasing power unchanged. If we expect the inflation rates in the USA and in Japan to stay at the same level, so prices in Japan will keep rising by 10% in 2 years and in 3 years and so on, and in the United States the prices will increase by 7% year after year after year, then we can calculate the expected spot exchange rate 2 years in the future, 3 years in the future, and so on, by adding the power 2 or 3 to the term 1 plus the 3% difference in the inflation rates. So the expected spot exchange rate in 2 years, denoted as E in square brackets S subscript 2, would equal S0, which was 120 yen per dollar in our example, multiplied by squared 1 plus 0.03, which gives 127.3 yen per 1 US dollar, and so on. In general, the relative purchasing power parity formula says to calculate the expected spot exchange rate at any point of time t in the future, so t could be 1 if it's in 1 year, it could be 2, it could be 3, 2 years in the future, 3 years in the future, it would equal spot exchange rate S0, which is the amount of foreign currency per 1 US dollar, multiplied by, open parenthesis, 1 plus the difference between the foreign inflation rate and the US inflation rate, close parenthesis, power t. The notations we use for the two inflation rates are lowercase h. So h subscript FC stands for annual inflation rate in the foreign country. H subscript USA stands for annual inflation rate in the United States. Let's do an example. Suppose the Canadian spot exchange rate today is 1.18 Canadian dollars per US dollar. The US inflation is expected to be 3% per year, and the Canadian inflation is expected to be 2% per year. The question is, do you expect the US dollar to appreciate or depreciate relative to the Canadian dollar? To answer this kind of conceptual question, we need to do some calculations first. Let's calculate the expected exchange rate or spot exchange rate between the Canadian dollar and the US dollar in 1 year. What do we do for that? Well, we use the relative purchasing power parity formula, which says take today's exchange rate, 1.18 Canadian dollars per 1 US dollar, and multiply it by, you open the parentheses, you put 1 plus, and then you add the difference between the Canadian and the US inflation rates, which is 0.02 minus 0.03. So it basically gives a negative number, negative 1% difference in inflation rates. The answer you get is 1.17 Canadian dollars per US dollar. So the number will drop, right? The number is expected to drop. If the amount of Canadian dollars per US dollar is expected to drop, who would benefit from that? Canadians or Americans? Well, each dollar will buy us fewer Canadian dollars, right? Each US dollar will buy us fewer Canadian dollars. So that's a bad thing for the US dollar. And so we say that we expect the US dollar to depreciate relative to the Canadian dollar. And the other way around for the Canadian dollar. The Canadian dollar is expected to appreciate or get stronger against the US dollar. Because let's say Canadians traveling to the United States would be exchanging fewer Canadian dollars to get each US dollar, which is a good thing for them, but a bad thing for the US. By the way, a problem like this could actually be solved in the financial calculator. Let me bring it up. Let's turn it on. So what is going on in this formula? We have 1.18, today's exchange rate. We multiply it by, and in the parentheses we have 1 plus the difference in inflation rates. So it may look very similar to the formula to calculate the future value of some today's amount. The today's amount is today's exchange rate, 1.18. So let's save it as PV. 1.18, let's make it negative, and then press the PV button, which stands for present value. We are calculating the exchange rate in 1 year, so that's our number of years, or N in the calculator. 1N. We want to calculate the future exchange rate after 1 year. So we are going to be computing FV, computing the future value. And one more thing that we need to enter in the calculator is the IY, the interest rate. Here, the equivalent of the interest rate is the difference between the foreign and the domestic inflation rates. Foreign minus domestic. Canadian inflation minus US inflation. So 2% minus 3% is negative 1%. And so in the calculator, I put 1 plus minus to make it negative, and I save it as IY. And then I want to compute the future value. Compute FV, 1.17, just like the number I found on my slide. So the equivalent of the IY to compute the future value is the foreign inflation minus the domestic inflation. Foreign minus domestic. Interest rate parity, IRP. It is defined as the difference in interest rates between two countries is equal to the percentage difference between the forward exchange rate and the spot exchange rate. Let me give an example of how this definition should be understood. For example, if Japan's interest rate is 4% higher than the US interest rate, then the forward rate should be 4% higher than the current spot rate as well. Otherwise, there is an arbitrage opportunity. Arbitrage means making guaranteed profit without taking any risk. So it's probably still pretty confusing what this whole interest rate parity is about. Let me explain it using the following example. Let's say you have $1. There are two things you could do with your $1. One, you could invest it domestically. Two, you could invest it, let's say, in Japan. Let's look at the option number one. You want to invest it domestically within the United States. You want to make a risk-free investment with a guaranteed return after 1 year. What is the name of like a risk-free asset in this country? It's basically, the short-term government bond called Treasury bill, and the return you would get on it is known as the risk-free rate. So let's say the risk-free rate on such short-term government bond in the United States is 4%. So the notation we use for the risk-free rate in the United States is capital R subscript USA, and that's 4%. That's one thing you can do to get your guaranteed 4% return on your $1. Instead, you could use your $1 and invest it overseas. And again, you want to make a very safe investment that will bring you a guaranteed return. It should be a risk-free investment. So whatever the name of the Japanese government's short-term bond is, that's the risk-free asset you would buy in Japan for 1 year. And let's say the risk-free rate there is 6%. So capital R subscript Japan equals 6%. 4% here, 6% there. One more thing we know in this example is that the current spot exchange rate is S0 equals 120 yen per $1. The question in this problem is, under which condition will you be indifferent between the two investments? Okay, so the question may sound very vague and kind of unclear what needs to be done. So let's see, let's kind of dig a bit deeper and do some math. How much are we going to have from today's $1 after 1 year? Well, if we invest $1 into the US risk-free asset with the return of 4%, then in 1 year, this $1 investment will grow to $1 times 1 plus the interest rate, RUSA, which equals $1 times 1 plus 0.04 in decimals, which gives $1.04, right? It's basically, the future value calculations. You could also do it in the financial calculator, where $1 would be your PV, changed to a negative number, N would be 1 because we want to find the value after 1 year. IY would be the return. You would put 4, and you would be computing FV. And the calculator will give you 1.04 as the answer. So that's how much you will have after 1 year from today's $1 if this $1 is invested domestically into the risk-free asset that brings a guaranteed 4% return. The second option was you instead invest your $1 into the Japan's risk-free asset equivalent. The return on the Japan's risk-free asset is 6%. Okay, well, first of all, we are kind of not really investing dollars in Japan. We should be investing yen. If you have $1 to invest yen, we need to first convert it into yen. What do we use for the conversion? Today's exchange rate, the spot exchange rate, which was given, right, 120 yen per $1. So $1 is multiplied by 120 yen per $1, which gives 120 yen. So really, you're investing 120 yen into the Japanese financial market. And now we want to do a similar math. in 1 year, this investment will grow to 120 yen times 1 plus 0.06, the return that's guaranteed after 1 year, which gives 127.2 Japanese yen. And then we want to compare apples with apples. So what does it mean in terms of dollars, right? So we can then compare, the value of this investment to what you would get if you instead invested your money in the United States, right? So we want to go back from yen to dollars, right? In 1 year, 127.2 yen will be exchanged back into dollars. How? So what is the name of the exchange rate that we can already know today, that will be used in 1 year to convert one currency into another? What was the name of such trade where we know what exchange rate will be used at some point of time in the future? That's the forward exchange rate, the 1 year forward exchange rate, agreed upon today. So whatever that rate is that is already known today, that would be used to exchange yen into dollars in 1 year, that's what we would need to use to convert next year's 127.2 yen back into dollars. So in terms of dollars, this investment made in Japan will be worth this much money in dollars, right? So it will be worth 127.2 yen divided by the 1 year forward. And 1 year forward will be expressed as how many yen it is per dollar, right? So you would divide next year's yen by yen per dollar, and you will be left with dollars, the dollar amount, right? And now let's summarize our results. So if you invest your $1 in the US risk-free asset at 4%, you will have $1.04. If you instead invest your $1 into Japan's risk-free asset at 6%, then in 1 year, in terms of dollars, you will have 127.2 yen divided by the 1 year forward rate. So whatever that ratio gives you, that's how much your investment will be worth in dollars when it's made in Japan. And now we can answer the main question in this problem, which was, under which circumstances would you be indifferent between the two investments? What does being indifferent between the two investments really mean? It means you don't care whether your $1 is invested in the United States or in Japan. What does it mean you don't care? In which case would you not care? Well, if you make the same money in 1 year, right? So how much money are we talking about in 1 year? We already have it for option number 1, $1.04. We kind of don't have it yet for option number 2. It's not very clear because we don't know what F1 is, the 1 year forward rate. But what we are basically saying is that regardless of whether your $1 is invested here or there, either way, it should give you $1.04 in 1 year. So you must make the same money, $1.04, in both the USA and in Japan. And we can now calculate in which case this will be true. What is our unknown? The F1 for the value of the investment in Japan. So $1.04, that's in 1 year in the United States, must equal 127.2 yen divided by the 1 year forward rate. And then we rearrange to solve for the 1 year forward rate. The 1 year forward rate should be 127.2 divided by 1.01, which gives 122.3 yen per dollar. This is the condition under which we will be indifferent between whether our $1 is invested in the United States or in Japan. The 1-year forward rate must be exactly 122.3 for us to be indifferent between the two countries' investments. If the 1-year forward rate is actually not that number, it's not 122.3 but something else, then we again have what we kind of keep coming back to when we learn every new formula in this chapter. We will have an opportunity to make profit, a guaranteed profit. In other words, an arbitrage opportunity. In this particular context with the interest rates, it's called a covered interest arbitrage. Let me go back by one slide and give you an example. Let's say the 1-year forward rate is not 122.3 but only 121. So it's less than it should be. If it's only 121, less than it should be, which country are you going to prefer? Are you going to want to invest in the United States or in Japan? Well, mathematically, if you look at where the 1-year forward rate makes a difference, it makes a difference for the investment made in Japan. So mathematically, if we divide 127.2 yen by a smaller number, we are going to get a bigger number as a result, which would mean that everybody would want to invest their money in Japan, where they would make more money after 1 year, rather than in the United States. That's if the forward rate is lower than what it should be for that indifference between the two countries. So lower than 122.3, such as, for example, 121 yen per dollar. And the other way around. What if the 1-year forward rate is higher than how high it should be? So let's say it's 125 yen per dollar. Then mathematically, for Japan, when we divide by a larger number, we get a smaller answer. Smaller means we will make less than $1.04 if we invest our money in Japan. So where would all investors be investing their money into? Not into Japan, but into the United States, where they get more money after 1 year. So in order for investors to not kind of all invest into just one country, in order for there to be sort of a balance in the investments made in this world, we must have this, condition that the 1-year forward rate between two specific countries should be calculated, the way we did it in this example. And the actual forward rate should exactly match this calculated number to prevent the covered interest arbitrage opportunity. This 1-year forward rate, F1, let's review how it was derived. This is how it was derived. If money is invested domestically, we take our $1 and multiply it by 1 plus RUSA. If money is invested overseas, then we take our $1, first convert it into the foreign currency by multiplying by the exchange rate, S0, and then we add the interest rate to it. So we multiply it by 1 plus the interest rate in the foreign country. And then we divide the whole thing by the 1-year forward rate, F1, to convert that overseas investment back from the foreign currency into the US dollar. Let's simplify it by getting rid of $1 on the left-hand side and on the right-hand side. So we have 1 plus RUSA equals S0 times 1 plus R foreign country, and then the whole thing on the right-hand side divided by the 1-year forward rate, F1. Then we can rearrange it, and it will look like this. F1 equals S0 times 1 plus R foreign country divided by 1 plus R USA. Or let's rewrite it the way that fits sort of the definition of the so-called interest rate parity formula, where it says that the 1 year forward rate divided by the spot exchange rate today equals 1 plus the interest rate in the foreign country for the risk-free asset divided by 1 plus the rate for the risk-free asset in the United States. So this is kind of the definition of the so-called interest rate parity formula that kind of comes out of the example that we just looked at, which shows how the forward rate should be determined in order for there to be sort of balanced investments across different countries. Let's do a little bit more rearrangement to this formula. Let's take this formula, the interest rate parity formula, and write an approximate version of it, where the right-hand side of it is simplified to 1 plus, and then we have the difference between the foreign and the domestic risk-free rates. One more rearrangement, so there are a whole bunch of them here, right? And this will be the last one that actually fits what we had at the very beginning when we started this whole topic on the interest rate parity. So this formula can be further rearranged to F1 minus S0. The difference is divided by S0. So it's the percentage difference between the forward exchange rate and the spot exchange rate. And on the right hand side, what we have remaining from this rearrangement is the difference in the interest rates. The foreign interest rate for the risk-free asset minus the domestic interest rate for the risk-free asset. So this is kind of where, you know, this definition of the interest rate parity is coming from. The difference in interest rates between two countries is equal to the percentage difference between the forward exchange rate and the spot exchange rate. Oh, sorry, I lied. We are rearranging it again. Okay. This is, there are so many different ways to write the same format, depending on what you leave on the left-hand side, which, notation, and what you decide to keep on the right-hand side. So we're rearranging it one last time as follows. 1 year forward rate, F1, that's all we have on the left-hand side, equals today's spot exchange rate, S0, multiplied by, open parenthesis, 1 plus the difference between the foreign country's risk-free rate and the US risk-free rate, close parenthesis. This is the approximate interest rate parity. And by the way, I have an example coming up on the next slide on both the approximate and the exact interest rate parity formulas. So this formula calculates what the 1 year forward rate that you're locking in today should be depending on what today's exchange rate is, S0, and how the risk-free rates differ between the foreign and the domestic countries. But we don't have to limit ourselves to the calculation of the forward rate for 1 year. We can also use this formula and kind of generalize it to find the forward rate 1 year from now, 2 years from now, 3 years from now, so any time t in the future. All we do is the term in the parentheses in this formula, we raise it to the power t, which shows that future time. In real life, forward exchange rates don't typically go beyond 1 year forward rates. Like on one of the earlier slides where I was explaining how exchange rates are quoted and showed you that table from the Wall Street Journal, you probably only remember seeing the 1 month, the 3 month, and the 6-month forward rates. So anything beyond 1 year forward rates kind of, does not really exist in real life. And that's because how would you be sure you're locking in the right exchange rate today that would be used in, let's say, 2 years, in 3 years? It's such a long amount of time that nobody would want to bet on what the exchange rate might be at such distant future time. Okay, let's look at an example. The exchange rate for the Japanese yen S0 is currently 120 yen per dollar. The risk-free interest rate in the USA is 10%, and the risk-free rate in Japan is 5%. What should the 1-year forward rate be in order to prevent the covered interest arbitrage? So this complicated question is essentially asking you to use the interest rate parity formula. That's the only one you can use that links today's exchange rate and the two risk-free rates in two different countries. We had the approximate version of it, and we are later going to use the exact interest rate parity formula. The approximate interest rate parity formula says to find the 1-year forward rate, we take today's exchange rate, which is 120 yen per dollar, and we multiply it by, open parenthesis, 1 plus, and then the difference between the Japan and the US risk-free rates. So 0.05 in decimals minus 0.10 in decimals. The math gives us 114 yen per dollar. The exact formula looked a little bit different. The exact interest rate parity formula says F1 equals S0 times, and then we have the fraction of 1 plus the interest rate in Japan divided by 1 plus the interest rate in the United States. When we plug in our numbers into this formula, we have 120 times, open parenthesis, 1 plus 0.05, close parenthesis, divided by, open parenthesis, 1 plus 0.1, close parenthesis, which gives a slightly different answer, 114.55 yen per $1. So the two answers are very, very close. I would say, it's always safer to use the exact interest rate parity because it gives you the true answer, the correct answer, whereas any approximate formulas give you a little bit of an error. By the way, the approximate interest rate parity can be used in the financial calculator. Let me bring it up. Let's turn it off and back on. Let's clear everything and start all over. So we want to find the 1-year forward. It's like finding the future value after 1 year. So what's 1 year? That's our n equal to 1. So let me start with that. 1n. What is the present value if we need to find the future value? The present value equivalent in this problem is the current spot exchange rate, 120 yen per dollar. So I put 120, I make the sign negative, and then I press the PV button. So we have PV minus 120. We had n equal to 1. There's one more thing we need to enter before we press compute FV, and that's the interest rate, the IY. What's the equivalent of the interest rate in this exchange rate problem? It's the difference between the foreign and the domestic interest rates. 5% minus 10%. What is that? That's negative 5%. So I put 5 plus minus IY. And then I press compute future value, 114. So 114 yen per dollar is the 1-year forward rate between the Japanese yen and the dollar that would that would allow investors to be indifferent between which country they invest their money into, whether it's Japan or the United States. Unbiased forward rates. I have one slide on this little topic. If you think about what 1-year forward rate is, so that's the exchange rate that people would want to lock in today that they would use in 1 year to exchange one currency into another. It probably makes sense if to say that the 1-year forward rate is nothing but what investors expect the actual spot exchange rate in 1 year to be. So F1 equals expected S1, and that's known as the unbiased forward rates. So biased would be like people expect the exchange rate to be this many yen per dollar, but somehow, for some reason, today they're locking in a slightly higher or a slightly lower exchange rate to be used in 1 year. That would be kind of, illogical, right? So it makes sense to say that the rate that people lock in today to be used in 1 year is exactly what they believe the next year's exchange rate will be. We can also apply it to any time in the future, even though in real life, technically, forward rates don't go beyond 1 year forward rates. It's more like a few month forward rate. But in general, for any year T in the future, and maybe this T is not even beyond 1 year, maybe it's just a few months. So maybe this formula is adjusted to reflect kind of a few months in the future. So for example, a 6-month forward rate equals expected spot exchange rate in 6 months. So in general, if T represents any time T in the future, then the formula can be generalized as F subscript T equals expected, open parenthesis, S subscript T, close parenthesis. Okay, what do we know so far? We have the relative purchasing power parity formula. Expected spot exchange rate in 1 year equals today's spot exchange rate multiplied by 1 plus the difference between the foreign country and the US inflation rates. 2. Interest rate parity. 1 year forward rate equals today's spot exchange rate multiplied by 1 plus the difference between the foreign countries and the domestic risk-free rates. 3. Unbiased forward rates. 1 year forward rate equals expected spot exchange rate in 1 year. What you can first do is, because the 1 year forward rate and the expected spot exchange rate in 1 year are set equal to each other in formula number 3, then in formula number 2, instead of putting F1 on the left hand side, we can instead put expected spot exchange rate in 1 year on the left hand side. So if you combine formulas 2 and 3, it will give us the so-called uncovered interest parity. Expected spot exchange rate in 1 year equals today's spot exchange rate multiplied by 1 plus the difference between the foreign countries and the US risk-free rates. So this is the uncovered interest parity. Then we can take this uncovered interest rate parity, which by the way can also be applied to any year T in the future if you just add the power T to the term in the parentheses. If you combine it with formula number 1, then we get another new result. So if you compare formulas 1 and the uncovered interest parity, they should look pretty much identical except for what we add to 1 in the brackets. In the relative purchasing power parity formula, which is formula number 1, in the brackets we have 1 plus H, which is inflation rate in the foreign country, minus the inflation rate in the US. In the last new formula that we have just derived, the uncovered interest rate parity. In the brackets, we instead have 1 plus the difference between the foreign and the domestic risk-free rates. So the difference in the inflation rates equals the difference in the risk-free rates. That statement must be true. So combining these two formulas, we have the difference in inflation rates, HFC minus HUS, equals the difference in the risk-free rates, RFC minus RUS. This last result can also be rearranged to put everything for the US on one side and everything for the foreign country on the other side. So for example, if we move RUS to the left-hand side, it changes the sign from negative to positive. If we move H foreign country from the left to the right, it changes the sign to negative from positive. And we then get RUS minus HUS equals R foreign country minus H foreign country. And this last formula has a name in the international finance. It's called International Fisher Effect. By the way, the term Fisher Effect should sound familiar because we already saw it in chapter 7. And actually this formula that we are now looking at should not look like anything new if you remember the Fisher Effect from chapter 7. So the International Fisher Effect says the risk-free rate in the USA minus the inflation rate in the USA equals the risk-free rate in some foreign country minus the inflation rate in that foreign country. The risk-free rate in the USA is also something that we call the nominal risk-free rate in the United States. And when we subtract the inflation rate, we get the so-called real interest rate in the USA. Same for the foreign country. The capital R subscript FC, that's the nominal risk-free rate in the foreign country. And when we subtract the foreign inflation rate from it, we get the real risk-free interest rate in the foreign country. So what does the International Fisher Effect formula imply? What does it say? It says that the real interest rate in the USA equals the real interest rate in some foreign country, right? So International Fisher Effect says that the real rate of return must be constant across countries. In other words, what are real rates of returns? It's when you adjust your return on your money for inflation, like how much of your return the inflation takes away. The fact that the prices get higher, right? That kind of, eats away part of the return you got in nominal terms. What would happen if the real interest rates were not equal across different countries? It would mean that investors would always have preference for like one country over other countries. Whichever country has a higher real rate of return on their money would be the only country they would move all their money into. But in order to have a balanced world of investments, we must have this International Fisher Effect, holding true, right? So the fact that people, investors kind of, some invest here, some invest there, tell us that the International Fisher Effect kind of generally holds. So if some countries have a really high interest rate that you can earn when you invest money there, it's probably because those countries also have very high increase in the cost of living over time, a high inflation rate. And so everything kind of gets balanced out. High interest rate countries have, the reason actually they have high interest rates is because of the high inflation. But the difference between the nominal rate and inflation gives like the true like wealth you earn on your money. And that true, like real rate wealth that you earn on your money should be equal across all the different countries. So that's what the International Fisher Effect says. Okay, we are done with all the formulas in this chapter. Now let's put all of the above together. Don't worry, it sounds a lot scarier than, it's going to be a lot easier than it sounds. That's what I'm trying to say. So let's do an international capital budgeting example. It means nothing but calculating the net present value for an international company that's evaluating its overseas investment opportunity. As always, we are going to be calculating the project's net present value. If the net present value we find is above $0, we're going to recommend to accept this investment opportunity. Otherwise, if the net present value is below $0, we would recommend to reject this investment opportunity. There are two different ways we could solve an NPV problem like that. Two approaches to overseas project valuation. The so-called home currency approach and the so-called foreign currency approach. The home currency approach first estimates the cash flows for year 0, 1, 2, and so on in the foreign currency. And then the idea is we want to convert those foreign currency cash flows into the home currency, into the dollars, right? As quickly as we can. So to do that, we would need to know which exchange rate to use for each year's cash flow. So we estimate future exchange rates. Which formula from this chapter can we use for that? We can use the uncovered interest rate parity formula. So we're going to review it in our next example. Once we have the exchange rate for year 1, year 2 in the future, year 3 in the future, and so on, we can then convert our foreign currency cash flows into the domestic currency cash flows, into the dollars. That's step number 3. And then in the last step, we just discount the dollar cash flows using the domestic required return to find the net present value in dollars. The foreign currency approach has everything kind of backwards, pretty much. We basically keep everything in the foreign currency until the very end. So we estimate our cash flows in the foreign currency. This is, the same step 1 across the two approaches. Then we discount them. So we're essentially finding the NPV in the foreign currency rather than in dollars. What do we use for the discount rate for that NPV calculations? We use the International Fisher Effect to convert the domestic required return to foreign required return. And then we do the discounting to find the NPV, which will be the NPV denominated in the foreign currency rather than in dollars. So it's like we are finding the NPV in the foreign currency. And only in the last step, we convert the foreign currency NPV into dollars using today's spot exchange rate. So it's like in the home currency approach, the first thing we want to do is convert all cash flows for the project into dollars. With the foreign currency approach, we want to convert everything into dollars last. And we are calculating the NPV in the foreign currency as kind of big step 1. Okay, so it turns out that it actually doesn't matter which of the two approaches you decide to use to find the net present value for your overseas project, because both will give you the same exact net present value. Let's look at the following example. A US cell phone company is considering selling its cell phones in Germany. The initial cost of this cell phone project in Germany would be 10 million euros. Notice how it's denominated in euros rather than in dollars. And that's kind of the whole point of this overseas project valuation. Everything starts with a foreign currency. Expected revenues from this project. It's actually more like profits. That would be a more correct word to use. After-tax profits. We learned that in chapter 10 in this class. So expected after-tax profits are 2 million euros in 1 year, 3 million euros in 2 years, 5 million euros in 3 years, and 10 million euros in 4 years. The risk-free rate in the USA is 5%, and it's 8% in Germany. The current spot exchange rate is 0.67 euros per dollar, which is the same thing as $1.50 per 1 euro. The required rate of return on similar investments in the USA is 10%. Calculate the net present value of this cell phone project in Germany. Okay, let's start with the home currency approach first. Step 1 says estimate cash flows in foreign currency. We already have them. They're given. Year 0 cash flow is negative 10 million euros. Year 1, 2 million euros. Year 2, 3 million euros. Year 3, 5 million euros. And year 4, 10 million euros. They're given, so we don't need to calculate anything for step 1. Step 2. The goal is to convert all the future cash flows back into dollars. So for that, we need to know what exchange rate we will use for each year. So in step 2, we estimate future exchange rate for each year using the uncovered interest rate parity formula. The formula says the expected exchange rate for any year in the future equals today's spot exchange rate multiplied by, open parentheses, 1 plus the difference between the foreign risk-free rate and the US risk-free rate, close parentheses, raised to the power t, t indicating the number of years in the future for which we are trying to estimate the spot exchange rate. So next year's expected exchange rate equals today's spot rate, which is 0.67 euros per dollar, multiplied by, open parentheses, 1 plus foreign country's risk-free rate, which is Germany's 8% rate, or 0.08 in decimals, minus the US risk-free rate, or 0.5%, or in decimals, 0.05. We don't use any power, although we could put 1 at the end of the, closing bracket. The answer is 0.69 euros per $1. So that's the expected exchange rate in 1 year. The only thing that we change in the calculations of the expected exchange rates for years 2, 3, and 4 is the power at the end of the parentheses. Powers 2, 3, and 4. And the answers we get are 0.71 euros per dollar, 0.73 euros per dollar, 0.75 euros per $1. The numbers will be kind of continuously increasing, right? And by the way, this means that the dollar is expected to get stronger because each dollar can give us more and more and more euros. But that's not the question that we are answering. So let's move on. Now that we have the exchange rates estimated for each future year of this 4-year project in Germany, we can then proceed to step number 3. Convert future cash flows from euro into dollars. So we had our cash flows in euros. We convert them into dollars using the appropriate exchange rate for that year. So for example, to convert the initial investment, 10 million euros, into dollars, we take 10 million euros and divide by 0.67 euros per dollar, which was given as today's exchange rate or the current spot exchange rate. This gives us negative $15 million. The same way we convert next year's cash flow from euros into dollars using the exchange rate we found in step number 2 for, as the estimated exchange rate for that time. So we take 2 million euros divided by 0.69 euros per dollar from the previous step, which gives $2.9 million. And then the same way we divide 3 million euros from year 2, 5 million euros from year 3, and 10 million euros from year 4 by their own exchange rates that we estimated in the previous step for years 2, 3, and 4 to give us the estimated project's cash flows for these years expressed in dollars. So the second year's cash flow in dollars is $4.2 million. The third year's cash flow in dollars is $6.9 million. And the final year's cash flow is $13.3 million. Okay, we're done with step 3. What's now left is combining all these cash flows from this project into one sort of summarizing dollar amount, which is the net present value, the profitability of this 4-year project. So step 2, discount the dollar cash flows using the domestic, the US required return. The required return on similar investments in the USA is 10%. It's given to us. So we take minus $15 million from year 0, and we add all future dollar cash flows discounted back to year 0 using the 10% given discount rate. So for example, from year 1 we add $2.9 million divided by 1 plus 0.1. From year 2 we have $4.2 million cash flow divided by 1 plus 0.1 squared. And then the third year's discounted dollar cash flow uses the third power in the denominator, and the last year's discounted cash flow uses the fourth power in the denominator. Of course, this is something you can do in just one step in the financial calculator. Either way, you get $5.41 million. And your conclusion for this project would be to accept it because it's worth it. Let's do it in the financial calculator. Let me bring it up. Let me clear everything. Second, plus, minus, enter. Off and back on. So cash flow keys in the financial calculator start with pressing the cash flow, the CF button. What's cash flow in year 0? It's minus $15 million. So let's drop the 6 zeros for the millions and do it in millions, right? So 15 negative, enter. Now it's saved. I press the down arrow key. The display shows cash flow or 1. What's cash flow number 1 in the future? That's 2.9 million. I put 2.9. I save it by pressing enter. I press the down arrow key. But before I enter my second year's cash flow, the display wants me to give the information on the frequency of the first year's cash flow, FO1. The default is 1, and we're going to keep it at the default value of 1, because we would only need to change it to something else, like 2, for example, if we had 2.9 million repeating again, consecutively, 2 consecutive years, back to back. But that's not the case in our entire problem. So all the frequencies for each of our future cash flow will actually be left at the default value of 1. So I can press enter and then the down arrow key again, or I could just press the down arrow key without pressing the enter. It would, not make any difference. Cash flow number 2 in the future, 4.2. 4.2, enter, down, and down arrow key again. Cash flow number 3 in the future, 6.9. 6.9, enter, down, down. And the fourth future cash flow, 13.3. 13.3, enter, down, down. That's it. There is no more cash flow number 5. Now I just need to compute the net present value based on all these cash flows I have just entered using 10% for the discount rate. 10% is given. So I press the NPV button. I is the interest rate that I need to enter. So I put 10, enter, down, compute. 5.38. So I think the reason I'm a little bit off from what I said earlier, which was 5.41 million, is because there must be some rounding error that happened when we were actually finding all these dollar cash flows, because we were really rounding them too much. They're like, remember, in millions of dollars. So there are like 6 more digits after the million value, right? So they're probably already rounded in the previous steps, and that's why I got a slightly different number. But for 5.41 million that I had explained earlier is more accurate because it's actually based on unrounded values. Okay, so 5.41 million if you don't round any of your intermediate steps, and that implies that the project is worth it. Now let's use the foreign currency approach. The first step is identical to what the home currency approach needs to start with. Estimate cash flows in the foreign currency. They're all given. You don't need to do any math. Let's go to step number 2. Step number 2, we want to figure out the right discount rate to discount the cash flows in euros. For that, we use the International Fisher effect. So the International Fisher effect says the difference in the inflation rates, foreign minus domestic, equals the difference in the risk-free rates, foreign minus domestic. With Germany being our foreign country, we have H Germany minus H US equals R Germany minus R US. Now let's plug in the numbers that we know. R Germany is the risk-free rate in Germany, that's 8%. R US is the risk-free rate in the USA, that's 5%. Both numbers are given in our problem. So the difference between 8% and 5% is 3%, which means 3% should also be the difference between the inflation rates, the two H's, right? H Germany minus H USA. And so what we can now say is that because we will have a 3% higher inflation in Germany, right? The increase in the cost of living in Germany. The proper discount rate in Germany needs to be about 3% higher than in the United States. And so what this means for the discount rate in Germany is that it should be 3% higher than the discount rate in the United States. In the United States, the discount rate is 10%, which is given. We add 3% from the calculations we just did, and we get 13%. So 13% is the proper discount rate for similar investments in Germany. And that's what we use in step 3. So this is step 3. We discount the foreign currency cash flows using the foreign required return. The foreign currency cash flows were minus 10 million, 2 million, 3 million, 5 million, and 10 million. In the financial calculator, those will be our cash flows, and then you would be entering 13% for the I, the interest rate. And you can do it all in one step. The answer you would get is 3.72 million euros. Let's check the math in the financial calculator. Let's clear everything. And I'm suspecting I might again get some rounding errors, but let's see. So let's turn it on, press the CF button. Cash flow 0 in euros, minus $10 million. Let's just drop all the 6 zeros. Just stick to 10, 2, 3, 5, and 10 again. 10, negative, enter. So we have just saved the cash flow for year 0 as negative 10. Press the down arrow key. Cash flow number 1 in the future, that's 2 million euros. I press 2, enter, down arrow key. What's the frequency of it? It's only once in a row. It's not repeated again in the next year, so I'm keeping the frequency at the default value of 1. The calculator uses 1 as the default. So I press the down arrow key. Cash flow number 2, that's 3 million euros. I press 3, enter, down and down again. Then for cash flow number 3, I need to enter 5 million euros, end of year 3. So I press 5, enter, down and down again. And cash flow number 4 in the future will be my last one. That's 10 million euros. 10, enter, down and down again. I'm done with entering my cash flows. Now I press the NPV button. It asks me for the I. That's where I put 13. Enter, down, compute. Yeah, so it matches the number I said earlier, $3.72 million, euros, sorry. And this is actually important. It's in euros. It's not in dollars, not yet. The NPV in dollars will be last as the very last step, which is step number 4. Step number 4, convert NPV from euros into dollars using current spot exchange rate. That's given, 0.67 euros per dollar or $1.50 per euro. So the NPV in US dollars equals the NPV in euros, 3.72 million euros, divided by 0.67 euro per $1, which gives $5.58 million. Again, the conclusion is the project should be accepted. You could also do this last step using the other exchange rate version, $1.50 per euro. But in that case, you would need to take 3.72 million euros and multiply by $1.5 per euro. But that would also give you $5.58 million as the answer. Let's compare the two results from the two approaches. The home currency approach gave us the NPV of $5.41 million. The foreign currency approach gave us a very similar number, the NPV of $5.58 million. They're practically the same. Actually, they would be exactly the same if throughout all our steps for the two approaches, we only used exact versions of all the important formulas rather than their approximate versions, such as, for example, the interest rate parity approach that we used in the home currency approach to find the, what do we use it for? We use it to find the expected exchange rates for years 1, 2, 3, and 4 in the future. So if we use the exact versions of those interest rate parity formulas, we would get also $5.58 million, just like with the foreign currency approach. The last topic is conceptual, exchange rate risk. What's exchange rate risk? Who faces this risk? It's the risk related to having international operations in a world where relative currency values vary. So if you deal with a lot of exchange rate transactions, you are facing the exchange rate risk because you don't know what the exchange rates will look like in the future. So currency values move up and down all the time, And because of that, multinational corporations that have their projects running in different countries, they face this additional problem of, trying to manage the exchange rate risk. It becomes an important part of international finance. We say that when you deal with exchange rates in your business, you have a short run exposure and a long run exposure to the exchange rate risk. So you have the short run risk and the long run risk, that the exchange rates will change in a way that you might see it affecting your business profits. What exactly is the short run exposure? So short run is typically a period of time within 1 year. Long run, anything longer than 1 year. That's kind of what we always use in finance, in econ, and other related fields. That's the default. The short run exposure to the interest rate risk is the risk from day-to-day fluctuations in exchange rates and the fact that companies have contracts to buy and sell goods in the short run at fixed prices. So how can we manage this risk? Well, we cannot eliminate the fluctuations in exchange rates in the future, but we can kind of lower our exposure to how much we're affected by these exchange rate fluctuations. How would we manage this risk? Well, we can enter into a forward agreement to guarantee the exchange rate. So, for example, you can lock in a certain exchange rate that will be used, let's say, in 6 months when you're planning to receive a huge income from your business, or when you're planning to spend money on some big expensive item. So you at least today what exchange rate you will use at that specific future point of time. So you kind of eliminate some uncertainty about what the exchange rate will be. The long run exposure, so think about what you can do to somehow lower the uncertainty about the exchange rates in more distant future, like beyond next year. So this has to do with long run fluctuations that come from unanticipated changes in relative economic conditions. So for example, think about all the things that could change how things run in this country or in the foreign country. Things like changing the governments, changing the tax laws, maybe some big events that can make a huge effect on the exchange rate. Maybe workers go on some strike, like big events like that you have no control over and you have no ability to predict, right? So those are kind of basically, they become very difficult to hedge. Also for the long run, like beyond 1 year, in real life, you don't really have forward rates, like 2-year forward rates, 3-year forward rates. They all end kind of, as 1-year forward rates. So you cannot even lock in any long-term exchange rates today that you would use at those more distant future points of time. So what you can do is you can try to match long-run inflows and outflows in the foreign currency. So for example, let's say you pay to your suppliers at the end of each month, and you typically receive your income from your business in the middle of each month. So now every month you have 2 points of time in which you deal with cash flows, whether they're spent or received. So you have a lot of points of time in the future for which you would have to deal with the exchange rate transactions. So how about cutting that in half? Let's say you arrange that every month you'll be paying to your suppliers in the middle of each month rather than at the end of each month, so that the timing of your expenses matches the timing of when the money is coming in from your business. So at least you're cutting down in half the number of times you deal with exchange rates, which are unpredictable. So this way, the dollar values of revenues and costs will move up and down together. Okay, so this is the end of chapter 21. What does an exchange rate really mean? It's the price you pay in one country's currency to get 1 unit of another country's currency. What is the absolute purchasing power parity, and what is the relative purchasing power parity? The absolute purchasing power parity says that the same commodity should cost the same amount of money in different countries if you just use the current exchange rate. The relative purchasing power parity also connects prices in two different countries and the exchange rate, except it does it a bit differently. It allows you to calculate what the exchange rate is expected to be, let's say, in 1 year, if you know how the costs of living or the overall price levels in the two countries will be changing in the nearest future. What is the interest rate parity? So this formula shows how the 1 year forward rate should be calculated when you know today's exchange rate and the difference between the risk-free rates between two different countries. Covered interest parity and uncovered interest parity. It's really the same formula except for what's on the left-hand side. On slide 33, the covered interest parity has F1, 1 year forward on the left-hand side. Slide 44 has expected exchange rate for that time on the left-hand side. What does the international Fisher effect say? It says that the real rates of return are equal or should be equal across different countries. What are the two methods for international capital budgeting? The home currency approach and the foreign currency approach. The home currency approach kind of right away tries to convert the project's cash flows from that foreign currency into dollars. That's where the name home currency approach comes from. And the foreign currency approach kind of keeps the cash flows as is, denominated in some foreign currency, calculates the NPV based on them. The NPV becomes in the foreign currency, and then only as the last step you do this conversion of the net present value from the foreign currency into the home currency, into the US dollars. Thank you for watching.